Hello all, welcome to ETF Edge, your go-to place for everything ETFs. Let's get right down to it. A stellar panel, as always. Our guest today, Dave Nadig, CIO and Director of Research at ETF Trends. Chris Hempstead from IndexIQ. And Simeon Hyman, he's the Global Investment Strategist over at ProShares. Gentlemen, welcome. Let's start with the poor showing of these transport ETFs today. I've been mentioning JETS. That's the International Airline ETF getting clobbered today. Dave, maybe you can weigh in on this. What has been interesting to me is not that they're getting clobbered. Obviously, Mr. Buffett said he was getting out is hurting them. But there's been a huge increase in the shares outstanding in this ETF in the last month and a half or so. Seems to me it's obviously because there are professional investors that are creating shares to essentially short them or to hedge with them. This is exactly what we saw with the oil ETFs a few weeks ago as well. Your thoughts on what's going on here, Dave?
Yeah, I'm a little skeptical that this is all create to lend. What we've seen is a pattern of consistent $20, $30 million flows day after day, which is really not consistent with a big rise in shares being shorted. We have seen that shares outstanding being shorted go up, but nowhere near as much as the money has come in. So in this case, I think what we're actually seeing is a lot of people trying to call the bottom. Remember, JETS is down something like 56% over the last 3 months. It's one of the only sectors of the market, one of the only ETFs affected that never caught a bounce. It's still trading very close to its March lows. So I think a lot of people are hoping that there's a government bailout, which is going to sort of act as the Fed put in this case. It's going to act as that buyer of last resort, because there's no question these are beleaguered and beaten up companies.
Yeah. Chris, I guess my only argument with that is that's what a lot of people said about the oil ETFs, that a lot of people were trying to play the bottom. Now, I know there's a difference here. We're dealing with equities in the case of the airline ETF, and with the oil ETF, we're dealing with oil futures, which is a different kind of phenomenon, obviously. But address this issue about professionals going in and playing in these ETFs for the purposes of shorting them or hedging with them, or retail investors coming in. In the case of JETS, do you have any sense of where the proportions are there? Chris, you there? I think we're having some problem. We're going to get Chris back in just a moment. Simeon, I don't know if you have any thoughts on this, but again, this is an eternal question for somebody like me that covers the ETF space. How much are these ETFs influenced by professional investors coming in and out versus retail investors? In the case of JETS, it seems to me like there would be more retail interest. So there is something that a point Dave has to make. But the creation of shares is so huge. It's about 20 times what it was 2 months ago, that you got to think there's a little more here than just individual investors thinking, airlines are going to get bailed out.
Yeah, well, I think with respect to ETF structure, what we know is that the ETFs themselves create additional liquidity beyond the individual shares. So that's kind of a good thing from a market construction standpoint. The thing I would note also, just from a more of a market look perspective, is that we know in the downturn that correlations went sky high. But now what we're seeing is that dispersion that's telling who's going to be winners and who are going to be losers, and what's going to be a very idiosyncratic recovery, whether it's troubles for the airlines or the energy sector, benefits for more tech-oriented online retail, things like that. So we saw this coming out in the recovery in 2019 out of the more modest downturn in 2018, that dispersion went big, correlations dropped across the S&P 500. So I think we're starting to see that idiosyncratic risk start to show up as well.
Okay, I think we got Chris back, and I'm sorry, Chris, you dropped out there. I just wanted to get your thoughts on this. We were all just discussing the role of professional investors in ETFs, noting that in the case of JETS and the oil ETFs, the creation of new shares had gone through the roof in the last couple of months. We were talking about where the breakdown is between retail and professional investors. In the case of JETS, I'm talking specifically. Any thoughts on this? You see active trading all the time. What do you see here?
Yeah, look, there's a lot of attention on it, Bob, and I don't think I have anything too academic to add, other than the fact that a couple of things are in play when the price of an ETF or any security really, but oftentimes an ETF drops to a very low number or something along those lines, we see day traders, if you will, jump in and start to trade millions and millions of shares. If you look at what happened with USO, yeah, I understand that oil was a top headline, but I think part of that was also the ease of trading a lot of the security at a low price. It's almost like it almost seems like a gambling tactic at sometimes. So I think with the airlines being so beat up, and I think there's a lot of people out there, retail, and probably some strategic investors, obviously not Warren Buffett, who might think there's an opportunity to get in here and take a shot. I don't think, it would be my place to say that the airlines are out of the woods, but an ETF like Jets might give people that opportunity to go in, try to buy low, and ride a rebound.
Yeah. I want to move on, talk a little bit about the Fed, because we got some news about a little bit more details on maybe what the Fed's going to be doing, buying corporate bond and high yield ETFs. This morning we got word they're going to begin buying in early May. Not exactly clear what that means, but they'll be buying $75 billion worth, but they'll be able to leverage that between 7 to 1 and 10 to 1. Not exactly clear how they're going to make that decision. So it's a very large amount of money they're going to be buying. And in a shot across the bow at everybody who was trying to front run the Fed, essentially, they said they would not buy ETFs that are trading at a premium of 1% to the net asset value, or even one standard deviation above the net asset value premium over the prior 52 weeks. And boy, was that a mouthful to get through all at one time. Dave Nadig, what do we make of this? This isn't far off from what we already know. It's good to know they're actually going to start buying, because we actually didn't know anything about when and if they were going to buy, and apparently they are.
For all we know, they could have already started buying, so we've gotten confirmation that they haven't. The real news here is this definition of what too big a premium is. And there was a lot of speculation around this, because we really don't have an instance where a government entity has come in and said what fair value looks like. So I think, obviously this is important for this specific set of buying facilities. We now know what the playbook looks like. I think this is going to have longer term implications, though, because now it's pretty easy to say, hey, what's too much of a premium or perhaps discount? Well, according to the Fed, it's 1% or one standard deviation more than the last year. I think that's a very reasonable way of thinking about that. The bond market is not nearly as efficient as we see in equities. So a plus or minus 1% on what is being called the net asset value is actually a very reasonable number. I do think this might have the interesting consequence of everybody piling into these ETFs, trying to get in before the Fed, and then the Fed maybe not even showing up because the persistent premiums.
Yeah, well, the premiums have collapsed, though. Simeon, weigh in on this. We went way above the premium, a premium to net asset value a few weeks ago, but that premium has collapsed. I looked at it at the close on Friday for LQD. I didn't see much of a premium at all there, and I don't think I saw one for high yield as well. So 1%, I agree with Dave. It sounds reasonable to me. What's your read on this?
Look, it's a reasonable marker. I mean, the one thing that most agree on with regards to the pricing of fixed income ETFs is that a lot of times the ETFs are just marking things to market before the less liquid bonds do. So that's an important marker. But also with regards to specifically the Fed now entering the market, I would argue that a lot of this was already priced in because they said that they could do it. So we saw spreads come in dramatically both in investment grade and high yield already. And even the mortgage market, which sort of had a minor kind of technical hiccup when this stuff first started, has started to calm down as well. So I think the medicine is working. The medicine already started to work, but it was good that they came out and told us a little bit more precisely what they were doing.
And Chris, I just want you to pick up on Simeon's point there. I think he's right in this debate. Why did we get such a wide spread here? A premium, it's because the ETFs had it right, not that they had it wrong. It was the bond market that couldn't price these products. What do you see down the road that could prevent these kinds of premiums and discounts occurring? Is there a more efficient way to price bonds? Do we need to go to more electronic trading? What's the lessons we can learn out of this now that everybody's not pointing the finger at the ETF business? Is why that happened. Sure. We all agree it isn't.
Look, I think those of us that have spent the last 20 plus years pricing ETFs on underlying asset information that's tangible and within arm's reach would love to see a more reliable and real-time bond pricing mechanism. Absent that, I don't think there's much that we can do about it right now other than trust that the true liquidity providers and those who are taking risk in fixed income, both on the bonds themselves or with the ETFs, are standing firm, and this is where they value funds. Now, I will tell you, with the spreads that we're monitoring on a day in, day out basis, they're still, in the ETFs, the spreads are still a bit wide. You're starting to see days where they'll be trading flat to NAV or 50 bips up or 50 bips down, but more often than not, you're seeing days where they're pushing 100 basis points over or 100 basis points under. So I have a feeling, that the bond market is not entirely, out of the woods yet in terms of spreads collapsing to the narrow levels that we have seen in the past, both in high yields and in investment grade. If the Fed comes in and starts buying these and, they push it up to a 1% premium, and the presumption is that they're going to be using the published INAV. Of course, that may not be the case. Maybe BlackRock has their own view of what it's worth, and they'll only pay 1% above that, if that's indeed who the Fed is hiring to do the bond buying. But the market is very wide right now. When there are sellers, the ETFs trade at a discount, and when there are buyers, they trade at a premium. They're whipping around a little bit. It's definitely a wider market for taking liquidity. Not as wide as we saw in the height of March, but it's still wide.
Well, I bring this up every week in the hopes that there's a little more of a microscope focused on this, and hopefully, I think it's clear where I stand. A little less over-the-counter trading, maybe more electronic trading will make it more efficient. At least we'll move the argument forward, and ETFs are not getting the blame. I want to move on here and talk about dividend ETFs because a lot of companies are cutting their dividend here. I just want to point out today, 114 companies in the S&P 500 has suspended guidance, and we're only 60% through earnings season so far. That's a quarter of the S&P. 79 have suspended the buybacks, and 31 have cut or suspended the dividends. And most of them who've cut or suspended are consumer discretionary, like retailers and energy stocks. So it is a particular subsector of the market that's cutting the dividends. But Simeon, I want to weigh in because you run one of the big dividend ETFs. You run the Dividend Aristocrats ETF. Symbol is NOBL. I wonder, this is a little teaching moment to educate us because there's a number of different dividend ETFs out there. I wonder if you could tell us what goes into that, how do you determine what goes into that, and how are these dividend cuts affecting something like NOBL?
I'll try to keep it relatively compact, but the key difference here is between ETFs that focus on dividend growth and those that focus on high yield. So Noble is absolutely in the dividend growth camp. And the rules for inclusion of the index, we follow the S&P 500 Dividend Aristocrat Index, is 25 years of uninterrupted dividend increases, and then the portfolio is equally weighted. This is a very high-quality portfolio, and that, I think, is much of the key here. If you look at, as an example, take the S&P 500 by quintile by credit rating. Half of Noble's constituents are in that first quintile. If you looked alternatively at a high dividend ETF like a DVY, only 10 to 15% of its constituents are in the first quartile or the first quintile of credit rating. So that's really important because what we've seen is the high yielders with the lower credit rating have actually underperformed in this downturn, even though interest rates came down, which should have helped them out a little bit.
Yeah, that's a great point. So, Dave, we've debated this for many, many years, and I think Simeon gave a very good summary there. Generally, if you're a dividend investor, you want to buy companies that are consistently growing their dividend over time, which is Noble, of course, versus just buying the highest yield. Now, under some circumstances, if the market's going up, that'll work fine. But in this circumstances, obviously, a company, an ETF like Noble matters here. Can you refine that a little for us? What observation would you make for dividend people?
Yeah, so what we're seeing here is a real division in the market between winners and losers. And I'm obviously not the first one to say that. And the winners here, I think dividend increases, or at least dividend consistency, is a pretty good quality proxy, right? If you actually look at people who've reported, what hasn't gotten reported very much is that folks like Apple and J&J and Costco and Newmont, they've all actually increased their dividend this quarter, which I think surprised a lot of people. Now, that's because of two reasons. One is these are companies that have the cash and cash flow to support it, but it also signals management confidence in their ability to weather this storm. So obviously, there'll be some changes here. I would not be surprised to see some shifts even in something like Noble, because not every one of those holdings is going to be able to keep this up. up. But regardless, I think that portfolio will continue to be a bit of a winners in this market portfolio because it is that proxy quality. So I agree. Yeah. I think it's a terrible time to be chasing yield, but it's a great time to be trying to find quality cash flow positive companies.
Well, Chris, weigh in on this. We've been talking about the difference between dividend growth and those that have a more emphasis on higher yield in their ETF. How worried should we be about defaults going forward? How likely do you think they are? How much are we going to be dealing with that?
I mean, the good news is a lot of the dividend ETFs are underweight energy and underweight, some of the oil sectors that the concern for default is the highest. Look at Mackay Shields, which is one of New York Life's boutique, high yield and investment grade and municipal managers. We talk about these things often in our muni products and our high yield products. The default concern right now is not incredibly high in certain parts of the high yield universe. Obviously, if you look at, state general obligation bonds and utilities, sewer and water and things like that, it would be a much lower risk. But if you look at, retirement facilities and things like that, the risk might be a little bit higher, Bob. So it really depends on what the funds are holding and what the active manager is going into, to qualify that answer.
And Simeon, apropos of what you were saying here, if you want to chase high dividends, you do end up with generally more energy stocks, as Chris was saying. So I'm looking at ETFs that have energy sector concentration. The iShares core dividend, the symbol is HDV, 20% of their shares outstanding are energy stocks. Noble has only, it says here 2.8%. I don't know if you know that off the top of your head, but ProShares, the Noble that you control, only 2.8%. So there's a very wide range of what you can hold in terms of high dividend in some of these stocks. Simeon?
No, I think that's right, Bobby. You see more energy the more you're stretching for yield. So Noble just having a small amount. The other thing I wanted to note, because this is the ETF show, is one of the key advantages of owning a basket like this in an ETF like Noble, which is, to Dave's point, are a couple of names going to cut? Sure, but guess what? When you own the ETF and you're following the index, if a company gets cut, then, and by the way, you want it to be cut from the index because a cutter typically underperforms. So when it gets cut, the proceeds are then invested pro rata across the other constituents. So as an example, if you go back to 2008 and you look at the S&P 500 Dividend Aristocrat Index, it lost names in 2008, but the dividend actually went up. You could try to do that yourself. You're going to have to, it's a little cumbersome. You're going to have to sell it, then you're going to have to move your proceeds around. But owning it in an ETF takes care of that logistical issue for you, and it's another
Well, is that going to happen now? Is that going to happen now? Have you lost any names? Is the dividend going up? Are we having a 2008 moment here with that?
There haven't been any names cut so far from the S&P 500 Dividend Aristocrats so far. So obviously we monitor that, and we think there'll be far fewer cuts than in the broader market. But just as that extra layer of belt and suspenders, if there is a name cut, you could actually see the dividend go up. It might stay flat. It probably won't change too much because you're automatically reinvesting across the rest of the portfolio. So it's kind of two layers of protection. Fewer will actually cut their dividends, and even for the small amount that would, you're redeploying those assets seamlessly in the ETF.
Okay. That does it, folks. I want to thank everybody for participating. We cover all sorts of things here. Transport ETFs, corporate and high yield, energy ETFs. We're right across the board. Everybody, thank you for joining us. And that does it for this week's ETF Edge. I'm Bob Pisani, and my thanks, of course, to Dave and to Chris and to Simeon for joining us today. You can thank you for watching. You can get all of our videos every week. We tell you the same place, etfedge.cnbc.com. We'll see you next Monday, same time, same place. Thanks for joining us.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.